Here we take a look at the cash budget and the budgeted income statement. Again, as we have seen this flow chart before, we have gone over all of these budgets up here and these budgets there and the selling and administrative expense budget. So now we're going to take a look at the budgeted income statement and the cash budget. The capital budget, again, we'll talk more about that in Chapter 12. Okay, so before we can do the budgeted income statement, we know the sales, and now we have the cost of goods sold budget. And we have the selling and administrative expense budget. So now those are the budgets we're going to need to be able to prepare the estimate of operating income. And so here shows us where we're going to get those things in the textbook and assumes that the tax rate is 40%. So here is our budgeted income statement for Texas Rex. We have our heading, name of the company, what is this? Notice the word budgeted is there to let people know this is not a real income statement with actual numbers. These are estimated for the coming year. So we would say for the year end 12/31 of whatever next year is. Okay. Now, we know that our income statement is revenues and expenses. We have sales minus the cost of goods sold. That gives us gross profit, which is also called gross margin. We subtract out our operating expenses, which are selling and administrative expenses, and that gives us operating income. Now, the operating income is the most important number on here, along with the gross margin to management, okay? But if we're going to go ahead and show the whole budgeted income statement, we would subtract any other expenses, we would add any other revenue that wasn't part of operating income, and then we get income before income taxes, and we multiply that times the 40% and subtract that of income tax expense, and we get net income $5,204 in this case. Okay, for the cash budget, is very important. Managing the cash flow in a business is critical, or you're gonna go under. Okay, so we have to know how the cash is coming in, how it's going out, when it's coming in, when it's going out, when we need to be ready to go get some financing, when we're going to have some extra cash that we can put into investments or into buying new equipment, etc. All right, so the basic structure of the cash budget includes any beginning balance plus any cash we expect to receive, and that will give us the cash available. Then we subtract out what we think we're going to spend out of cash, and that gives us our expected ending balance. So the cash available includes the beginning cash plus any cash receipts we think we're going to get. The principal source of cash is from sales, especially cash sales. So when we sell our product or service for cash, people hand us cash. That includes them handing us checks, and it also includes them using a credit card or debit card, because we're going to get the cash usually within a day or two. And so we can count that just like a cash sale. So all those kinds of sales, just not the immediate cash will come from those kinds of sales. But we also can sell on account to people where they don't give us the cash until 30 days from now, but we're still going to get that cash. We just have to time it, okay? Now, here they talk about a large portion of sales is usually on account. A lot of that depends. If it's a retail place that's dealing with the public, then there's probably more cash sales as opposed to sales on account. So Walmart does not set up an account and let you buy things from them on account. Okay, but any kind of wholesaler and any kind of manufacturer, their sales are usually all on account. Okay, so the major task of one of those organizations is to determine that pattern, because some of that cash is coming in later, but we got some cash coming in today from sales that we made last month. So we have to get all that straight. Okay, it can, if the company has been in business for a while, it can use past experience to determine what percentage of credit sales are paid during this month of the sale, and how much of our on-account sales do we get the cash next month, and how much do we get the cash 2 months from now. Okay, and then we can create a schedule. Okay, so from past experience, Texas Rex expects that on average 25% of total sales are cash, period, cash sales. 75% of their sales are on account. Of the credit sales, the on-account sales, they expect that 90% will be paid in cash during that same quarter. So, in other words, if I sell on account in January, 90% of those sales will have been received by the end of March, which is the end of the quarter. The other 10% will be paid in the following quarter. Okay? This reminds us of what the following total sales are going to be. $10,000 of sales we expect in quarter 1, $12,000 in quarter 2, $15,000 in quarter 3, and $20,000 in quarter 4. Those all came from the sales budget. Okay, and here's the sales budget, just as a reminder from one of the first videos, in which we said how many units do we think we're going to sell, times it by the $10 per unit that we think we're going to have of a sales price, and that tells us the total sales we think we're going to have. Okay, so the balance in the accounts receivable, according to the book, as of the end of the prior year is $1,350. So we expect this to be collected in cash during the first quarter. So we're going to show how much do we expect. Now, in the first quarter, the cash sales, remember, they expect cash sales to be 25%. So we're expecting our total sales to be $10,000, and we're going to multiply that times 25%. So we expect to get cash out of the $10,000 of sales. We expect cash of $2,500. The other $7,500 is on account sales. The same thing, quarter 2, we expect $12,000 of sales. We multiply that by 25%. So we know we're going to get somewhere around $3,000 of cash, and the other $9,000 is on-account sales, etc., through the quarters. Okay, so now we're going to prepare this schedule. And so let's take a look at carefully going through this. The first line is the cash sales that we just figured. Okay, the 25% of total sales we think is going to come in cash. So we put that on there first. Okay, now from here, received on account from quarter 4 of the prior year, we said that customers owed us $13.50, and we expect to get that in quarter 1 in cash. Okay? Now, quarter 1, we expect to get cash of $67.50 from the on-account sales. So remember that 25% of the total sales are cash sales. 75% of the total sales, which for the first quarter, total sales was $10,000. We multiply that times 75%, that's $7,500. That's how much we think the total on-account sales are. Then we also said in the previous slide that on the on-account sales, we expect to get 90% of those in cash this quarter. So this is $7,500 of our on-account sales times 90%. So we expect to get cash this quarter from our on-account sales of this quarter of $67.50. Then we expect to get the other 10% of the $7,500 on-account sales in the next quarter. Okay, so there's the $7,500 times 10%. So together, these two amounts equal the $7,500 on-account sales that we expect for quarter 1. Now, quarter 2, we expected to get $12,000 of sales total. So $12,000 times 25% is our cash sales, which is up here. $12,000 times 75% on account means that we expect to get $9,000 on account in quarter 2. Now, of that $9,000 on account, 90% is going to come in cash, where the customer pays us off by the end of the quarter, and 90% of 9,000 is $8,100. And the other 10% of the 9,000 will come in the next quarter. Now, things are technically a little more complicated in this because when we sell on account, we can expect that some of our customers are never going to pay, period. We're going to lose those. They're going to be bad debt expense. So, and we'll know how much that is. Maybe it's 1%, okay? So, $90 in the case of quarter 2, we might not receive ever, okay? And this is just disregarding that whole thing. Now, quarter 3, it said we were going to get $15,000 of sales. So 15,000 times 25% is how much we get as cash sales. And 15,000 times 75% is $11,250 that we expect to do on account sales for the third quarter. Out of that $11,250, we expect 90% of those customers' amounts to pay us in cash by the end of the third quarter. So 11,250 times 90% is 10,125. And the other 10% of the 11,250, 1125, we expect to get in cash in the fourth quarter. Now in quarter 4, we said we were going to get $20,000 of total sales. $20,000 times 25% cash sales is $5,000. The $20,000 times 75% on account sales is $15,000 total on account sales. And out of that, 90% we expect to come in cash, so $15,000.